Introduction, and thank you everyone for coming this evening. For those who are unfamiliar, perhaps I'd like to start just with a very brief overview of Rockhopper. The company was founded in 2004 and listed on the AIM market in 2005, really with a focus on oil exploration in the North Falkland Basin in the South Atlantic. In 2010, we discovered the Sea Lion field, which was the first commercial oil discovery in the Falklands. And through 2010 to 2012, we drilled another 9 wells, 7 of which were successful in appraising the greater Sea Lion area. In 2012, we farmed out a 60% interest in Sea Lion and all of our interests in the Falkland Islands to a company, another UK listed company called Premier Oil, for consideration of about $1 billion. And since 2014, we've been seeking to diversify our portfolio, and through a series of transactions, we've built what we believe is an emerging second core area in what we call the Greater Mediterranean, so Southern Europe and North Africa. The company today has a market cap of about £175 million, and we have no debt. Our strategy is to build a well-funded, full-cycle, exploration-led E&P company. As I said, our portfolio today is focused on 2 specific core areas, the North Falkland Basin and the Greater Mediterranean, with a balanced portfolio across the asset life cycle, all the way through from production, development, appraisal, and exploration assets. Although we are still today very much dominated by our exploration and appraisal interests in the Falkland Islands. Our balance sheet is strong, with 110 million of cash as at the year end 2015, and our operating cash flows from our Italian assets, and also from an acquisition which we've recently announced in Egypt, should largely cover our corporate costs going forward. We seek to add value to our shareholders through value accretive exploration, leveraging our technical skill set, focusing on proven hydrocarbon basins, and we are progressing a number of high impact, relatively low risk exploration opportunities in Italy, Malta, Croatia, and now in Egypt as well. We've made significant progress over the last 18 months, delivering against our corporate objectives. On Sea Lion, which is the main discovery down in the Falklands, we have completed the conceptual design work, and the project has entered the detailed engineering and cost phase, which we call FEED. That's about an 18-month program that will take us through all the way through to mid-2017, at which point we will have done all of the engineering work as well as all of the regulatory engagement work around the field development plan to have a sanctionable ready project. On the exploration front, we drilled 3 wells through 2015 and the early part of 2016 in the North Falkland Basin. Each discovered oil. And in Italy, we increased our production from around about 250 barrels of oil equivalent per day at the beginning of the year to over 700 barrels of oil equivalent by the end of the year. That was through a number of sort of development projects in Italy. And then, as I say, through our recent acquisition in Egypt, we'll be adding a further 1,000 barrels of oil equivalent per day. On the corporate side, we acquired a company called Falkland Oil and Gas, which completed in January 2016. Really what that was all about was consolidating our leading North Falkland Basin exploration position. And as I say, we maintain a strong balance sheet, and after the acquisition and the various costs that we expect to occur this year, we're estimating a year-end cash balance of around about $70 million. Turning now to the Falklands in a little bit more detail. Through a combination of the exploration campaign and the acquisition of Falkland Oil and Gas, Rockhopper is once again the leading Falklands explorer. We've consolidated our acreage position, now holding 40% in this top area, PL 032, which contains the bulk of the Sea Lion field. And we have also acquired increased our interest to 64% in PL 004, which contains the Zebedee discovery that we made last year, as well as the Isabella Lane complex to the south of PL 004, which we believe has the potential to contain up to 3, 4, possibly even 500 million barrels of recoverable oil after further appraisal work. In addition, we've added operated positions in PL 003 and PL 005. Through the exploration campaign of 2015 and 16, we've established that the North Falkland Basin is more than just Sea Lion. I mean, Sea Lion itself has got 500 million barrels, which if that was in the North Sea would probably be one of the largest, if not the largest, discovered but undeveloped oil fields. But through the exploration campaign of 2015 and 16, we've demonstrated that this is not just an oil field, this is an entire basin, with what management believe has the potential to deliver over 1 billion barrels of recoverable oil over time. I won't go through the numbers in detail, but following the completion of the exploration campaign, we commissioned DRC Equipoise, which is a well-renowned, competent person, independent engineering firm, to undertake an independent resource audit, which has confirmed what I think we've been saying for some time, which is that Sea Lion contains north of 500 million barrels recoverable oil on a 2C basis, and on a 3C basis, over 900 million barrels of recoverable oil. In addition, through the exploration campaign, we've established contingent resources in the Isabella Lane complex, which is to the south. And while we encountered drilling difficulties, which meant we didn't acquire all the data that we had hoped to acquire, we are nonetheless, we remain of the view that there contains a significant volume of commercial recoverable oil in Isabella Lane. In addition to the 3 wells that we drilled, because of the success we've had, that's allowed us to gain information about the subsurface and has allowed us to identify and significantly de-risk additional follow-on prospects for drilling. And based on the independent resource estimate, there's probably another 200 odd million barrels of recoverable oil in the north, round about Sea Lion. Round about Sea Lion up here, and an additional sort of 300 million barrels of prospective resource sitting around Isabella Lane. So on top of the sort of 500 million barrels we've already discovered, there's lots of additional running room for further growth, and future drilling activity. In terms of Sea Lion itself, as I say, it's a 500 million barrel field, but what we're looking to do is develop it on a phased basis, really with a view to maximising project value but minimising upfront costs. So through phase 1, we'll be looking to commercialise about 200 million barrels of oil, which will really be focused on the northeast and northwest corner of PL 032. That'll be produced through an FPS, leased FPSO, with around about 18 wells, and producing about 75,000 barrels a day on a gross basis. Now, net to Rockhopper's 40% interest, that's about 30,000 barrels a day, and that equates to, roughly speaking, at $50 or $60 oil, over 500 million barrels of gross revenue net to Rockhopper per annum for the first 3-4 years. So there is very material upside for Rockhopper once sea lion is in production. On the cost side, we've made significant progress. What you find in the oil industry is that when the oil price falls, costs on the service side and on the supply side also fall. There's a bit of a time lag, but that trend is being borne out. So what we've been able to do, or what we've been doing over the last 12 months or more, is engaging with the contractors, engaging with the supply side, really with a view to reducing our upfront costs as much as possible, therefore improving the overall project economics. The official cost estimate today is 1.8 billion capex to first oil, which equates to about $8 per barrel. So really quite competitive if this was ranked against other projects around the world. What we hope to be doing through the FEED process is reducing that upfront capital costs to below $1.5 billion. And at the same time, a combination of rescaling the project, as we have talked about here, and pushing down the costs. We're targeting a 20% project rate of return based on a $55 oil price. So at between $45 and $50 a barrel, we'd be looking at around about a 10% return. Now, because this is an emerging basin, it's the first in the Falklands, it's difficult to see exactly what sort of project returns you would need in order to justify a sanction decision. But you can see that at round about $50 a barrel, which is where we are today, this project very much stacks up. Going forward, we've got the FEED process, which will last another 12 months or so. The purpose of the FEED is really to do the detailed engineering work and at the same time narrow the range of cost estimates for the project. In parallel with FEED, as I say, we'll be continuing to evolve and progress the field development plan in engagement with the Falkland Island government. And really all of those come together in mid-2017, which is our target sanction date. And it's at that point a decision will be made as to whether we progress with the project and enter into binding contracts with service providers and contractors to develop the field. Now, ultimately, that decision will be driven by three factors. The oil price outlook, the cost savings that we're able to achieve over the next 12 months, and ultimately the ability of the partners to fund the development. Premier Oil, who are the operator and our partner, have said that they are actively looking for a farm-out partner to shoulder the burden of, or a significant burden of, the costs required to take Sea Lion through project sanction. The next slide here is really just a schematic to demonstrate what I was talking about before, the multiple phases of future development that we see here. And really just again reinforcing the idea that this is not a single field, this is an entire basin that we're looking to commercialise over a 15, 20, 30-year type time horizon. In terms of production levels, phase one, as I said before, will be targeting about 75,000 barrels a day production. And once you brought phase two in, you could see production going up sort of around about 125,000 barrels a day. So this is a very, very material oil development, which we'll be looking to commercialise through multiple phases, multiple FPSOs. And just to give you a sense of the scale, from Sea Lion over to Isabel Elaine, there's about 30 to 35 kilometres distance here. And if we go to some of the previous slides, you'll see that there are a number of exploration targets, both around Sea Lion, but also going to the south around Isabel and Elaine. Moving on to the Greater Mediterranean, which, as I say, is a much newer and relatively smaller part of our business compared to the Falklands. What we're really looking to do with the Greater Med is build a production base that generates operating cash flow that allows us to create a more sustainable business. The previous model of Rockhopper was we'd farmed out to Premier, we had cash on the balance sheet, and that cash was steadily being eroded as we ran the company and we invested in Sea Lion. What we're looking to do with the Greater Mediterranean is put relatively small amounts of capital to work, buying production that has a quick payback and allows us basically to cover the corporate costs going forward. And therefore we're retaining the cash on the balance sheet for capital investment. So we acquired the Italian portfolio through an acquisition of a company called Mediterranean Oil and Gas back in 2014. And then more recently, we announced the acquisition of a portfolio in Egypt. That deal is expected to close in the next month or two. But a combination of this portfolio of producing assets, we will be around about 1,500 to 1,800 barrel of oil equivalent per day. And on a full year basis, assuming oil prices of around about $50 a barrel, we'll be looking at revenues in the order of $15 million per annum. So as I say, that puts us on a sort of steady footing to allow us to continue to cover our corporate costs and retain that balance sheet for investment in our project in the Falklands. A very short funding update. Cash at year-end 15 of $110 million. We're spending money on Sea Lion this year in the order of about 20 million, progressing the feed work, and about 10 million probably on our Egyptian acquisition, subject to working capital movements. We expect that deal, as I say, to close in the next couple of weeks. Our preliminary cash estimate for 2016 is in the order of $70 million. And I haven't really talked about this previously, but through our commercial arrangements, when we sold the 60% interest in Sea Lion back in 2012 to Premier Oil, we got 230 million of cash, but we also got significant development carries. So assuming we can get Sea Lion costs locked in at 1.5 billion, our share of that, because we have 40% of the project, is 600 million, but actually Premier will fund the first 337 million of that on our behalf. That leaves us with a funding gap of in the order of $250 million. And to fund that, either we can go to Premier Oil and ask them for a loan of up to $750 million, or we can go out to the bank market or the bond market and source alternative, cheaper, more flexible sources of debt capital to fund that residual balance. So either which way, assuming we can get the project sanctioned middle of next year, we are fully funded all the way through that development and all the way through to that point where, as I say, the project will be generating 75,000 barrels a day on a gross basis and $600 million per annum of revenue net to Rockhopper. So just in summary, very difficult market conditions for the E&P sector, the exploration and production sector. Rockhopper, I think, is well positioned, we're well funded, strong balance sheet, we've got no debt, we've got operating cash flows that cover our costs. We have significant development upside in the Falkland Islands, as I've demonstrated, and in the Greater Med, we continue to build that business and build momentum in what we call our second core area. So that was very quick, but thank you very much.